Welcome to the Deep Dive, your shortcut to being well-informed. Today we're diving into Nordea's second quarter 2025 results. This past quarter was, well, let's be honest, a bit of a whirlwind, marked by high uncertainty, global trade tariffs, and those ever-present geopolitical tensions. Yet despite these strong headwinds, Nordea reported a surprisingly robust performance. Our mission today is to cut through the noise, unpack these key numbers, understand management's insights, and ultimately figure out what it all means for you. So let's kick things off with the headlines. Nordea truly delivered strong profitability, boasting a return on equity of 16.2%.
Yeah, 16.2%. That's solid.
Right. And that keeps them firmly on track to meet their full-year guidance of above 15%. Earnings per share came in at a solid 35 cents. We also saw healthy growth across some crucial metrics. Mortgage lending was up 6%, retail deposits jumped by 8%.
Pretty significant jumps there.
Definitely. And both corporate lending and deposits grew by 5%. Even assets under management showed impressive growth, increasing by 9% to 437 billion euros. Operating profits stood at a very stable 1.6 billion euros quarter on quarter. And notably, their capital position remains rock solid, with a CET1 ratio of 15.6%.
Right, well above the requirements.
Exactly.
What's truly fascinating here is seeing such a resilient performance in what management themselves described as, turbulent markets. These numbers aren't just good. They underscore Nordea's structurally improved profitability and strong position as a, market-leading financial services group. And what really stands out to me is that significant net loan loss reversal that isn't just good. It signals exceptionally strong underlying credit quality in their portfolio.
That's a powerful start. Okay, let's unpack some of the nuances behind these numbers, starting with net interest income, or NII.
Yeah.
We saw a 6% decrease year on year and a 2% drop quarter on quarter. What exactly was driving that?
Right. Well, this NII trend was largely expected. It aligns with the declining interest rate environment we've been seeing. But here's where it gets interesting. That decline was partially offset by a positive tailwind from higher lending and deposit volumes. And crucially, they also had a significant contribution from their deposit hedge. Think of this as a financial tool they use to protect against falling interest rates on their deposits. That hedge effectively added, 127 million euros compared to Q2 last year and 19 million euros against Q1 this year.
Wow, so quite an impact from the hedge.
Absolutely. Their net interest margin for the quarter ended up at 1.63%. So this proactive hedging really helped them mitigate a significant headwind.
So effectively, they're using these financial instruments to smooth out interest rate volatility. That's a clear strategy. Now, I noticed that net fee and commission income remained stable year on year, even with the market turmoil impacting, brokerage and advisory fees. It seems areas like card and payments activity picked up and savings fee income held steady. What does that tell us?
Yeah, and if we connect this to the bigger picture, it suggests strong underlying customer activity and a high demand for risk management products, particularly in foreign exchange and interest rate products. It indicates that even when traditional investment areas are challenged, customers are still highly engaged with their banking services and, seeking ways to manage their own risks. While Q1 is typically a peak for net fair value results, Q2 remains solid and basically in line with expectations, showing continued demand for these services.
Okay, we've seen how they're managing their income. Now let's look at the expense side. Costs were up 3%, excluding foreign exchange effects. What are the main drivers here?
Well, more than half of that increase is directly attributable to their strategic investments. And these aren't just minor tweaks. They're substantial commitments across technology, digital capabilities, data and AI, and cybersecurity. Plus, there were costs associated with their Norwegian acquisition, which is, a strategic growth move. Management has been quite firm on their commitment to cost discipline, though. They expect cost growth to slow significantly in the second half of the year, aiming for no more than, I think it was, a 2 to 2.5% increase for the full year. So there's spending to grow, but with a clear eye on the bottom line.
That brings us to credit quality, which the earnings call painted as exceptionally strong. Net loan losses amounted to a net reversal of 21 million euros, well below long-term expectations. And they also released more from their management judgment buffer. What exactly is this buffer, and what does it signify when they release from it?
Right. So the management judgment buffer is essentially a reserve they proactively set aside for potential future loan losses. It's above and beyond what their standard models predict. This quarter, they released a further 60 million euros from that buffer, which now stands at 341 million.
Okay.
Releasing from it signals management's strong confidence in their current credit portfolio's health, as they no longer see the need to hold those extra provisions. They actually indicated we might see further releases in the second half of the year, consistent with their strategy of either using or releasing this buffer based on their evolving view of risk.
That sounds like a strong vote of confidence in their underlying loan book. Now, it seems their robust performance also extends to their balance sheet. Let's talk about their capital position. How strong is it, and what does it enable them to do? Their CET1 ratio, for example, stands at a very healthy 15.6%.
Yeah, their CET1 ratio, which is a crucial measure of a bank's core financial strength and its ability to absorb potential losses, is indeed at a very healthy 15.6%. That's a full 1.9 percentage points above their current regulatory requirement.
Which is quite a buffer itself.
Exactly. This strong capital generation reinforces their ability to support continued lending growth, absorb the impacts from future regulatory changes like Basel IV, those global rules designed to strengthen bank capital standards, and also fund ongoing share buyback programs. Their current €250 million buyback program is expected to complete by the end of September 2025. This robust capital position really highlights their flexibility to deploy capital strategically, whether for growth or shareholder returns.
Okay, so we've seen the big picture. Now, how are the individual business segments contributing to this overall strong performance? Let's start with personal banking, especially in the mortgage market.
Personal banking performed well, showed solid growth in both lending and deposit volumes. Mortgage lending was up 6% year on year, driven by strong growth in Sweden and Norway, where they've also gained market share. While overall activity in the Nordic housing market is still a bit muted, it's definitely showing a gradual recovery. We're seeing increasing demand for loan promises.
So signs of life there.
Yeah, it signals a cautious return of confidence.
What about business banking and large corporates? Are we seeing activity levels pick up there, especially given the broader economic uncertainty?
In business banking, lending volumes grew by 4%, mainly in Sweden and Norway, which signals higher activity among small and medium-sized enterprises. So that's encouraging. Large corporates also saw lending volumes grow by 4% year on year, or 6% when you adjust for foreign exchange effects, with a noticeable pickup in June, actually.
Oh, interesting.
Yeah. Despite macroeconomic uncertainty, Nordic businesses seem cautiously optimistic, buoyed by their strong competitive positions. While equity capital markets remain challenging, Nordea was very active in helping customers raise financing through debt capital markets and even led multiple Nordic IPOs.
Which is a good sign of their market leadership, definitely.
Absolutely.
Asset and wealth management seems to be a real standout, particularly their private banking business. What's the story there?
Indeed. This segment maintained really strong momentum, driven by solid investment performance and continued growth in private banking. They attracted impressive net flows of €2 billion in private banking in Q2 alone, with Finland and Sweden being key drivers.
$2 billion in one quarter.
Yeah, it's significant. Overall, they reported impressive first-half net inflows of €8.1 billion. And despite some margin pressure from customer preference shifting towards lower-risk products and institutional clients, their life insurance and pension business also continued to perform very well. So it shows the breadth of their offerings.
So Nordea feels firmly on track to hit that return on equity target. What's the strategic vision moving forward, especially with the Capital Markets Day just around the corner?
Well, management expressed strong confidence in their unchanged 2025 outlook. They really emphasized the strength of their well-diversified business model and the distinct advantages of operating in the stable Nordic markets. They're preparing for their Capital Markets Day in London on November 5th, where they plan to unveil their strategy for 2026 and beyond. The core themes seem to revolve around building on their successful foundation, becoming even stronger in the Nordics, growing income above market rates.
Right, outperforming the market.
Exactly. Leveraging their unique Nordic scale and continuing to deliver market-leading return on equity and superior earnings per share growth. Their unique Nordic scale isn't just a geographical descriptor. It appears to be their secret sauce, if you like, for counter-cyclical resilience.
So what does this deep dive mean for you as someone tracking the financial sector, especially in the Nordics? What are the key takeaways from this earnings call?
I think it really highlights Nordea's remarkable resilience, their ability to perform strongly amidst significant global trade volatility and geopolitical tensions. Their strong financial and fiscal position within the Nordic economies provides a robust foundation, allowing them to navigate these turbulences effectively where perhaps others might falter.
Looking ahead to the second half of the year, especially with Q3 seasonality and continued NII pressures, how should we think about their outlook?
Well, Q3 is typically quieter, vacation periods, and often a cautious, risk-off customer sentiment. But Nordea anticipates momentum building into Q4. They acknowledge the ongoing NII pressure from the lower rate environment and, competitive corporate lending margins. But they're confident in the deposit hedge continuing to perform as planned to mitigate that.
That's how again.
Exactly. And their consistent cost discipline also remains a key factor in supporting profitability, helping them weather these cyclical pressures.
Let's touch on some of the longer-term structural and regulatory elements that came up in the call. Things like the Norwegian systemic risk buffer and the Basel IV output floor. These can sound complex and, frankly, potentially concerning for investors. How should we interpret Nordea's stance on them?
Yeah, management was quite clear and I'd say confident on these. Think of the Norwegian systemic risk buffer as an extra financial safety net. Regulators require banks to hold in certain countries just in case something big goes wrong. While it increases their overall capital requirement by about 20 basis points, Nordea's management views it as, and I quote, no problem for their capital distribution capacity.
Because their capital base is so strong already.
Precisely. They actually disagree with what they perceive as double counting in regulatory requirements and are advocating for better coordination within the European system. Similarly, while Basel IV's output floor, that's the new global rulebook designed to make banks even stronger by setting a minimum level for how much risk-weighted assets they need to hold, while that could theoretically increase risk-weighted assets, Nordea doesn't see it as a headwind. They expect a third of that impact to fall away next year due to technology enhancements, and they anticipate broader market solutions for unrated corporates by 2033.
So they have a plan.
Seems so. It does raise an important question about how regulators can better harmonize macro and microprudential requirements globally, though.
That's a lot of technical detail, but it sounds like they have a clear path forward for those. Finally, any specific business segments or country performances that stood out as having particularly strong momentum or opportunity for the coming quarters?
Absolutely. Their asset and wealth management business, particularly private banking, is showing excellent momentum. It's a significant contributor to their net inflows. In their core banking operations, Sweden continues to be a strong performer, actively gaining mortgage market share there.
Right.
And Norway is also building well following their recent acquisition. They're seeing positive signs of increased activity levels, especially in corporate lending, which bodes well for a stronger finish to the year.
So what does this all mean? Here's where we get to our not financial advice segment, where we pitch an outrageous but plausible trade idea based on today's deep dive, really just designed to get you thinking.
Okay, so given Nordea's strong Q2 performance and management's confident outlook, our thought-provoking trade idea for you is a strategic paired trade. Go long Nordea NOIA equity while simultaneously shorting a less diversified Nordic banking peer.
Interesting. A pair trade.
Exactly. The core conviction here is a bet on Nordea's unique operational discipline, its proactive approach to managing regulatory impacts, and its strong market leadership within those stable Nordic economies. They appear uniquely positioned to outgrow the market and deliver superior EPS growth, even as sector-wide net interest income compresses. By shorting a peer that might lack Nordea's scale, business mix, or capital flexibility, you're essentially amplifying a conviction on Nordea's relative strength and its demonstrated ability to consistently return capital to shareholders while maintaining that exceptional asset quality.
All right. To wrap things up, Nordea delivered a truly solid Q2 performance, showcasing strong profitability, robust capital generation, and a confident outlook despite continued market volatility. Their well-diversified business model and strategic focus on the resilient Nordic home markets clearly position them for continued strength.
Yeah, the call truly underscored management's belief in their ability to meet their full-year ROE targets and navigate these evolving regulatory landscapes. It sets an ambitious tone for their upcoming Capital Markets Day, too.
Okay, and remember everyone, the content of this deep dive is for informational purposes only. It should definitely not be considered financial advice. Always do your own research or consult a financial advisor before making any investment decisions. So here's a final thought for you to mull over. Given Nordea's clear confidence in navigating market volatility and their strategic investments, how might their unique Nordic scale truly reshape their competitive landscape in the years to come? And what could that mean for the broader European banking sector? Something to think about. We encourage you to explore this further. Until next time, we look forward to hearing your thoughts and questions on this deep dive or areas you'd like us to unpack next.